Thanks. Damn, the market's on fire. It's not great. Not great at all. Cheers. Let me so goddamn rich.
I think it's time to blow this thing. Get everybody in the stuff together. Okay, 3, 2, 1, let's go.
Fucking rich. What's up, Javi? What's up, John? Got in first. Good man.
Griffin, I want my fucking money. Yo, motherfucker. Holy shit, we're gonna be so fucking rich.
God damn, we're gonna be rich. Just make sure you're properly fucking hedged. Holy shit.
Damn it, we're gonna be so fucking rich.
Pretty much. What's up, Mike, Corey, Ryan? It's good to see you guys and girls. Thanks for coming out. Eric, Neil.
I want my fucking
Good deal,
money.
Domas.
Hey, yo,
Check that out.
Give me the fucking money.
It's the peace pipe.
Get the goddamn money printer out.
Sergio, tell me what happened, brother. Woo!
We're gonna be so fucking rich. Get the goddamn money printer out.
Holy crap. Yo, thanks so much for coming out, everybody. Again, Marcel Kalinovic, Boss Blunts here. I just had to drop some information over here for you guys. I know everybody's well aware of what's going on in the stock market. Things are not looking good. If you took out some calls on the VIX, good for you. I think you're going to do really well if you gave yourself enough time. Let's just say the volatility index today has gone from 16 on Wednesday. The market was closed on Thanksgiving. Today, Black Friday, we're looking at around 26 or 28 if I recall correctly here. But it is it's starting to get pretty crazy. I see Sergio, he got 5 options each on the VIX that went up 18,000%. Fuck yeah! That's what I'm saying. We're going to be fucking rich. Just got to properly hedge yourself. Wow, dude. Martin, I'm sorry I haven't watched Rico's videos. I've been very busy with my family and doing other things around here, other due diligence. But let's check this out. Let's get to it. We'll switch on over here. Straight down to brass tacks, you guys. The VIX is the volatility index, Alexander. The volatility index happens to go up when the stock market has huge changes in price, usually whether they be up or down or in both directions. What's up, CBJ? Alexander, it's good to see you guys. What are we looking at right here? The Q2 report from the Bureau of Economic Analysis stating that personal income for Americans in the second quarter decreased by 22%, $1.32 trillion in the second quarter. Disposable personal income in the second quarter decreased 26%, also another $1.42 trillion. Real disposable personal income decreased 30% on top of that. Personal outlays by expenses by Americans. Guess what, guys? Because of inflation, what is now nearing hyperinflation, our expenses in the second quarter increased $681 billion after having increased $538 billion in the first quarter. So that's 1.3 trillion in the last 2 quarters. This was led by an increase in PCE for services, personal consumption expenditures, inflation. Come on, man. Nothing's wrong, huh? It's just transitory. Personal savings was 1.97 in the second 7 trillion. Let me start over. Personal savings in the second quarter was 1.97 trillion, and in the first quarter it was 4.07 trillion. America, my friends, investors, we have lost over half of our savings. In the first quarter we had $4.07 trillion, and now in the second quarter we had $1.97 trillion. But wait, that's not all. We get more. In the third quarter, personal savings was down even further to $1.6 trillion. Come on. Why? Rising cost of goods, inflation, supply chain issues, shipping cost increases to get a container overseas, and trucking. Yeah, you can actually hear my daughter practicing the flute in the background, Sergio. That's funny. I appreciate it. Yeah, she's way on the other side of the house, but it's a pretty damn good microphone, apparently. Gotta love the Blue Yetis. The personal savings rate, again, let's keep it going. The personal savings rate was 1.97 trillion in the second quarter, down from 4 trillion in the first quarter, and in the third quarter is now down at $1.6 trillion. That's now 8.9%. So in the first quarter, we were saving almost 21% of our savings in our accounts, in our savings and investment accounts. And as of the third quarter, that's down to 8.9%. That's pathetic. That's pathetic. We are losing every dollar that we've saved up over the years to inflation. And there are many ways to hedge against that, in my opinion. Stocks that run inverse to the market and things like the VIX are very good. That's why I love AMC and GameStop. That's why I like the VIX. There's a lot of other things out there as well. The U.S. 10-year Treasury yield fell yet again. We spent weeks for it to climb up 0.1%. And in one day, I'm sorry, you just watch that. It's moving right now. It just fell some more as I was in the middle of that sentence. The 10-year Treasury for the United States yield is down yet again today. It was futures were down on Thanksgiving. The S&P 500, Dow, and NASDAQ futures were all down pretty damn heavy. Now today, in addition, yields around the country are down and around the world. Whoa, look at that. We just updated over here on the 3-month Treasury bill as well. Let's get this thing moved around because I just pulled that up about 5 minutes ago. It's not looking so hot. 0.058% yield to invest your money for 3 months. Does that sound like a good idea when inflation's at 14%? Come on. Come on. You got to be fucking joking me. Now, Treasury bond yields, these rates are tracked by investors for a lot of reasons, okay? These yields are paid by the United States government as interest for borrowing money for selling the bond. So you buy their shitty bond, their junk bond, for 3 months, and you get 0.058% return. Or you can take out a 10-year investment in U.S. 10-year Treasury yields of 1.47%. A Treasury note matures in 2 to 10 years, while a Treasury bond matures in 20 to 30 years. So there are varieties of differences here between the words of Treasury notes and Treasury bonds. So that difference is that a Treasury note is from 2 to 10 years of age, and a Treasury bond matures in about 20 to 30 years. The 10-year Treasury yield is watched very closely as an indicator of broader investor confidence. These are backed fully by the United States government and are supposedly viewed as a safe investment. But why would you invest your money for 1.47% for a 10 years when inflation's nearly 14% currently? You know, bond prices and yields move in opposite directions. So falling prices boost yields, while rising prices lower yields. So that's a very bad sign for the economy overall. The last time it was lower than it currently is was in 2020. And it's not looking so hot. This is where we were before the 2018 market crash. And if you go back even further, back in 1982, the 10-year yields were around 14%. And it's been an exponential downward curve since. So these are very important numbers to be gathering. The importance of the 10-year bond is is important because of the return on investment that you get. It's like a proxy for other finances, such as mortgage rates. So mortgage rates are directly dependent and correlated to the 10-year Treasury bond. When confidence is high, prices for the 10 years drops and rise. And the confidence factor is felt outside the United States, where various situations such as Evergrande collapsing, as well as Kaiser and about 9 other Chinese developers right now are in terrible shape. Make sure you're properly hedging yourself. I'm not a financial advisor, and this is not financial advice, but you need to be very careful when things like this start happening. You be very careful where you put your money and how you invest it. This is the 3-month Treasury bill rate as well. And at 0.06%, the only time it's been worse was during the peak of COVID, when we didn't have these supply chain issues that we're currently seeing, at least not to this extent. And these supply chain issues coming from a logistics manager such as myself are going to take 3 to 4 years minimum before they're worked out. Yeah, 3 to 4 years. I am not exaggerating. This was a study of consumer sentiment done by the University of Michigan, published on the FRED, the Federal Reserve Economic Data website. Currently, let me scoot that over for you. Currently, consumer sentiment in October is at 71.7. And the funny thing is that in 2007, right before the market started to correct, it was at 96. Then came down into the 80s, and then the 70s, and then the 50s, and continued to trend along the 50s for several years, for a couple of years there, 50s and 60s, all the way through mid to end of 2009. I'm sorry, everybody. I hate to be the bearer of bad news. And the reason I laugh is because it's so ridiculous that there's not much else I can really do about it other than try to explain to people what's actually happening here. Last year, the 3-month yield was at 0.08%. Right now, it's at 0.06%. The long-term average was 4%, and we will not see those numbers again for decades. Not years, decades. This is the beginning of a Great Recession, a Great Depression, in my opinion. Current dollar personal income increased $47 billion in the third quarter, but in the second quarter, we lost $1.29 trillion. So who gives a fuck if it increased by $47 billion in one quarter if we lost $1.29 trillion in the quarter prior? And in the first quarter, current personal income decreased $1.32 trillion. Sorry, in the second quarter, 22%. And it had increased previously that $2.3 trillion in the first quarter because of Biden bucks, because of Trump dollars, stimulus packages. That being said, the PCE price index currently increased 6.4%, compared with an increase of 3.8%. And that was in the first and second quarters. Looking at the third quarter, we're now much higher on the 6.4% range. We've been in that range for the last 5 months. This is worse than it ever was in 2008. And sadly, if you calculate this the same way that it used to be calculated in 2008, inflation would be between 11 to 14%, which I think seems a lot more accurate. What happens? I'll say this quickly because you probably heard this before on my channel from me. What happens when the stock market collapses or when the stock market takes a big, massive hit to a downturn like this? Hedgies got to hedge and shorts got to cover. And it may be a slow, long ride to the top of the roller coaster. But when we get to the top, it's going to start coming down slowly and accelerating more and more quickly every day. Good luck. We're going to be fucking rich. Let's go. You guys, you need to be real careful what you're doing here. Make sure you're hedged properly. I like calls on the VIX. I like AMC and GameStop. To each his own. I know what's heavily shorted in my eyes and what I think is going to work well for me, but everyone's got their own financial position to be worried about. On that note, I've got a call with some people regarding Xchange. I got to speak to some attorneys here in the next 60 seconds. I got to go. Have a great day, everybody. Peace and wealth. We're going to be fucking rich. God damn. Woo! We're going to be fucking rich. Happy holidays. Happy Thanksgiving.